My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. All right, how could the S&P 500 close at a record high when we got such a terrifying inflation number this very morning? Simple. When everyone expects an outrageous government statistic, then it isn't actually outrageous when you get it. So when the Labor Department reported a red-hot number this morning, Consumer Price Index up 5%, the biggest year-over-year increase since August of 2008, the market took it in stride. Dow advancing 19 points, S&P gaining 0.47%, hey, new high, and most important, the tech-laden Nasdaq climbed 0.78%. The inflation winners in the Dow underperformed today, while the classic growth stocks, Nasdaq names like Microsoft, ServiceNow, Adobe, CrowdStrike, Amazon, and Alphabet, they all roared. It's like when you're throwing a surprise party for someone and they find out ahead of time. They usually try to pretend that they didn't know, just to spare you the embarrassment. Today, many people pretended they didn't know about this inflation number, which is why you got a real faux surprise. It was so obviously going to be hotter than the projections that didn't you have to wonder, I mean, who the heck is making these stupid darn forecasts in the first place? Here's the thing, though. When you've got a phony surprise, everyone always afraid that someone's not in on the joke, that some big firm with a lot of stock will be shocked and say, wow, that's awful. The Fed will have to tighten immediately. So, sell. The fear of clueless big money keeps people on the sidelines. Once the number prints and nobody freaks out, the buyers who've been biding their time come in off the sidelines and buy. But are those buyers being too glib? It may not be a surprise, but 5% inflation seems pretty serious, doesn't it? I mean, want to force the Fed to tighten, wreck the economy? Not so fast. This is a case where you have to read the fine print. Remember, Fed Chief Jay Powell keeps insisting that this inflation is transitory, meaning it will eventually subside, even if the headline numbers currently seem real bad. When you break them down, though, it sure looks like Powell may be on to something. First, the biggest price increases were for used cars and trucks, up 7.3% in May, continuing a trend from April. Used vehicles alone accounted for 1/3 of the total consumer price inflation. Transitory? You bet it is. What's happened here is that new cars and trucks contain a lot of semiconductors. Right now, we've got a chip shortage because no one expected this level of demand. Last year, COVID sparked an exodus from the cities to the suburbs. Who thought that would happen, forcing millions to buy cars? Meanwhile, all the semiconductor foundries are running at full capacity, so the automakers haven't been able to expand production. That means anyone who needs to buy a car or a truck pretty much has to buy used, wherever you can find them. If it all really does go back to the semiconductor shortage, though. And the thing about chips is that the foundries are pumping them out 24/7. Plus, there was a fire at a major Japanese facility a few months ago. Now that's coming back online. Sooner or later, these are going to reach equilibrium, and then the market will be flooded with supply. And this problem? Transitory. It'll resolve itself. Remember, there's nothing the Federal Reserve can do to solve the chip shortage. We need more foundries, not higher interest rates. Now let's take down more line items from the CPI report. Airline fares jumped. Woo, I say so what? Of course, airline tickets are up huge over a year. Nobody was flying in May of 2020. Plus, the airlines did misjudge the strength of the Pfizer and Moderna vaccines. So they haven't grown their capacity to keep up with new demand. But there are more than 90 new airlines launched this year. And there are plenty of planes to be had. Fares will plummet once these companies get rolling. Next, oil and gas. All right, this one's tougher. We all feel it. But this is actually another supply issue. Remember, the Biden administration is no friend of the oil patch, right? I mean, witness the big give up on the Keystone Pipeline today. The Trump administration sowed the seeds of oil and gas price destruction by encouraging companies to drill and build pipelines. Now, though, there will be far fewer pipelines built, and oil companies are far more concerned about environmental issues, so they aren't producing as much. Again, that's got nothing to do with interest rates. The more President hates oil, well, the higher the price of oil goes. The grain complex, way up, too. However, This is another problem that tends to fix itself if you give it enough time. When grain prices spike, farmers buy more equipment and plant more crops, which in turn sends prices back down. And that is exactly what's happening. Go read the Deere conference call if you disagree with me. What else? I'm not surprised that dining out costs more. Something like 150,000 restaurants closed during this period. The remainder need to charge more in part because they haven't been able to make it up in volume due to COVID restrictions. Now that these restrictions are easing, prices should come down, or at least stop climbing. Sure, Starbucks is talking about a cup shortage, but they had more volume themselves because so many of the independent coffee shop competitors went under. They just misjudged. The supply chain glitches in this industry tend to be related to freight and plastic. Plastic prices have roared because we've got so many petrochemical plants along the Gulf Coast, and they've gotten hammered by Winter Storm Uri. As for freight, well, that one, I got no answer on that one. We don't have enough truck drivers. It's a difficult profession. They need to pay them more. When people fret about inflation, that's what they're really afraid of. They're afraid of wage inflation. That's what they're scared of. But before you start freaking out about Weimar Republic level hyperinflation, remember what we really saw in last Friday's non-farm payroll report. The labor participation rate, it fell 0.1%. Average hourly earnings were up just 0.5% month to month, and they only increased by 2% year over year. Meanwhile, the average work week actually fell 0.1%. Honestly, I'm surprised these numbers are so low given the pressure from expanded unemployment benefits. Those benefits go away in September. It wasn't that strong an employment number. How about the port congestion that's playing havoc with so many goods? All right, get this. There's a little inside baseball. I think the pressure goes away when commercial flights restart from Asia to the United States. They're going to make a comeback. Do you know that lots of cargo normally travels on those passenger planes, not just in the containers and ship? Once they start flying again, that logjam is going to diminish. Put it all together, and it's no wonder the Federal Reserve is keeping rates low. They don't have to lift a finger. Most of these problems are going to sort themselves out. In fact, it's already happening. Baltic Freight Index, great proxy for commodity demand, chiefly out of China. It's come down a great deal in the last couple of weeks. That's a big reason why almost all the industrials got just crushed today, while the drug stocks they took off, even as that's exactly the opposite of what you'd expect if the red-hot CPI number actually took anyone by surprise. Okay, look, I am not saying that we've got inflation whipped now. I'm saying there are too many things that went wrong last year, and most of them won't be solved by higher rates. Businesses just weren't prepared to handle such a strong economy. But that's a high-quality problem, and they don't need a rate hike to work things out. Time will do it for them. I think Jay Powell's gradual approach is prudent. I'm betting he's going to be dead right. So we should just simply stop bugging the darn guy already. He's doing a real good job. Bottom line, maybe Powell's responsible for a big chunk of this rally in the stock market, or maybe business is just plain good. Either way, the only truly non-transitory inflation I see is from that Wall Street bets mob who've gotten in their heads somehow to inflate stock prices, although even that's probably temporary, given what happened to the meme stocks in January and given what happened to them today.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.